This video is going to illustrate to you a projected cash flow for the Ridley farm. We've used the Ridley farm before, and these are just names that I give to some of the farm samples that I have accumulated over the years. I will post the Ridley cash flow on Moodle, so you'll have an Excel copy of this to look at. This is a projected cash flow for the coming year. If you'll notice, I have broken it into three major categories. And those categories are the farm inflows, which is in the yellow background, the cash outflows of the farm, which is in the light blue background, and then down here in the green background we have what's referred to as the analysis for the farm if it needs to borrow money to run the farm. In other words, does it need an operating loan? It is not the intention of this video to talk about how all of the section that is in green is calculated. I will do that in a separate video. It's just in this one, it's just to illustrate to you how there are the different sections and where the numbers might come from and how to read the cash flow. Notice in the yellow background box there are numbers in the different months. These numbers are simply projections by the farm of the amount of money they think will come in that particular month. So for example, this farm has got a couple of corn items listed. It might be different varieties, might be different farms, whatever reason. This number right here is simply based on the farmer's projected yield and projected price. So this farmer's sitting down saying, I think I got this many acres, I got this, I'm going to get this yield and I'm going to sell it for this price. He multiplies those three numbers and that's his projected revenue. Same thing for each of these. They're all projected revenues. This is a little bit of an unusual farm that I've got here. It's got some sugar beets on it. But actually, it was a sample farm that come from the northern part of the United States. But again, that would be acres, yield, and price. This one's got some government programs put in and then just some miscellaneous income. All of these are cash money. This number here for corn would not include any accrual adjustments for storage, strictly cash sales. This line right here for capital sales, that would be an example of capital sales would be like selling an old piece of machinery of some kind, and you would project the revenue and put it in whatever month you thought that sale. Non-farm income would be like the owner or the spouse working off the farm. Now, it would be the farm manager's choice whether to put anything in these sales. If you wanted the cash flow to show money available that you could use from the non-farm, put it in. But if you wanted the cash flow just to illustrate the farm portion, then maybe you wouldn't put that in. The new loans row, this row right here, if you're going to borrow money for term debt, and not an operating loan, but term debt. So you're going to buy yourself a new tractor. It's going to cost $70,000, and you want to borrow 60,000 of that. The banker's got to put that 60,000 into your bank account. So whatever month you projected to make that purchase, you'd have to put that $60,000 into your cash flow because that would be money coming in. Now remember, that's just term loans, not operating loans. All right, the arithmetic for the totals will be shown in a separate video, but you can see that these are simply totals. Now, when you take a little quiz over cash flow, one of the questions is going to be to take one of these cash flows. It'll either be the Ridley farm or one of the others, and it'll simply ask you some questions like, in what month did this farm think they're going to sell sugar beets, for example? And what you'd do, you'd say, well, it's in September. And it might ask you something like, what's the total cash operating receipts in June? Well, you'd want that number there. Of course, you don't put the comma or the dollar sign in. So in other words, one of the things the quiz is going to do is simply, it's going to give you a cash flow and say, can you read it? Okay. In the blue box down here are estimated expenses. Now, of course, the estimated expenses are simply going to come from previous years, but you might have to adjust those for newer prices. So, for example, this particular cash flow projects a seed cost, and let's see, that's January, February, March, April, and that number is simply going to be quantity times a projected price. So it might be something like the number of acres of a crop, number of pounds of seed needed per acre at some price. Again, this is fertilizer. That's a projection based on acres, type of fertilizer, and price. And remember now, these are projections. So you'd look at last year's usage of, say, fertilizer or chemicals. You'd take a look at current prices and try to project it. Obviously, you may not hit it exactly, but remember, these are your best estimates of what those expenses are going to be, and in the month you're going to have those expenses. Okay? This line right here simply, this line right there simply summarizes the cash operating expenses. Remember now, in this cash operating expense, there's no accrual adjustments. There's no inventory change, no change in prepaid expenses. These are nothing but cash expenditures because we're dealing with money flows. This line for capital purchases right here would be a check you would write for a new machine. So remember that $70,000 tractor, and we were going to borrow 60,000. Well, 60,000 would be put as income, not income, excuse me. I said the word wrong. An inflow, and then you'd write a check for 70,000 in whatever month you projected. This family living is simply money taken out to live on. Now, a farm manager may or may not want to put something there. If you're not, if there's other sources of income and you do not want to relate that to the farm, you might not put any family living here. But if you're going to take some money out of the farm business, then we need to put some money into family living. This row here is simply an estimate of income tax that the farm will have to pay, income tax and self-employment tax. And now this row here, these two are simply estimations. Now, not last year, but this coming year's estimation of interest and principal on debt. So now this is term debt. So if you have a tractor loan or land loan, and of course if you were having to make monthly payments, there'd be something in every single month. This farm simply has annual payments. So that could be a principal and interest payment on a land note, or it could be principal and interest payment on a large machinery note. But it's any kind of term debt that you got to pay in the coming year. Of course, totals down here are simply the totals of all the cash outflows. So now remember, the cash inflows are simply the farm projecting when they think money's going to come in and in how much based upon acreages and prices and yields. Cash operating expenses is an estimate of when the farm's going to spend money. Again, it's based on quantity and prices. It's not necessarily income and expenses. It's inflows and outflows. Okay, when you get to the analysis section down here, cash difference right here is income, excuse me again, inflows minus outflows. Okay? So what you would do, this would be a formula. It would be equal to, and you'd go get total cash inflows and subtract total cash outflows. This beginning cash balance right here is simply what you started the year with. Cash position is a sum of cash difference and beginning balance right here. So you see, if you take minus 14,898 and add 10,000, you got a minus 898. Okay. In a cash flow, we usually assume that the lender, if you're going to borrow money, requires some ending balance. So if the bank says you've got to end every month with 3,000, and if your cash position is a minus 48.98, you're going to have to borrow 78.98 to get to 3,000. Okay, now think about that again. Your cash difference for the month of January was a minus 14,898. You started the month with 10,000. So your cash position for the month is a minus $4,898. Okay? The bank says you got to end the year with 3,000. So you're going to have to borrow 78.98 for the year. Okay? That means your accumulated borrowing is up to 78.98 and you end the year with 3,000. Now if you end, you end the month. If you end the month with 3,000, that number goes directly up to the beginning cash balance the next month. Now in February, inflows minus outflows, you were $12,180 short. You started the month with 3,000, so you're 91.80 short. So you're going to have to borrow 12,180 to get back to 3,000. But when you add that 12,180 you borrowed in February to the 78.98 you borrowed in January, your loan balance is going to be up to 20,000. Now this process will be explained in great detail in another video, but this section of the spreadsheet that's in green simply shows how much money the farm's going to have to borrow each month. And then we get over here in June and they have a surplus of money, then they begin to pay some of that loan back. So the other video is going to show you how to calculate the interest, how to calculate the principal, and when you actually have money available. So this video has illustrated to you the three main sections of a cash flow. The section where you project inflows, the section where you project outflows, and then a section where you project the operating loan. In other words, how much money you need to borrow by months uh, to run the farm business. Once again, there will be a separate video that will show you the details of the arithmetic of this green section.